All right. Well, thanks everybody for joining us for our July webinar Wednesday. Today we have with us John Gibbons from Mutual of Omaha. We're kicking off our 3-month series around long-term care. So thank you, John, for joining us. And we're going to let you take it away.
All right. Good morning, everybody. Thank you very much. If any of you are new to KAFL, I could tell you, you're in a great spot. Seasoned veterans there across all product lines. So you're in great shape. My background, I've been with Mutual of Omaha about 3.5 years. Prior to that, One America for 4 years, and then forever with Genworth, 17 plus years. There's a lot of experience with asset-based and traditional. What we're going to talk about today is like LTC 101. So we're going to go through the basics of this. There's a chat box. If you have questions, you can probably type them in that or the question box, and we'll try to get to those. And let me go ahead. I thought I had one more thing I wanted to say, but it'll come to me as we move along. So with Mutual of Omaha, we have 2 different products, secure and custom. Strongly suggest sticking with custom. Custom is our better product, and I'll touch on why in a bit. There's more options to it. Years ago, secure might have been the better play, but not anymore. All right, so let's talk about creating a plan. So for those of you not familiar with long-term care, you have basically 4 moving parts. Once we set the stage here, everything else hopefully will fall in the line and make sense. So one of the first things you want to figure out is your monthly benefit. So if I go on claim, how much do you want Mutual of Omaha paying for my care? Now, the idea here is you're not trying to cover the whole cost of care, especially up in the Northeast in New York, Connecticut, and New Jersey, things like that. Incredibly expensive, right? So, if you try to cover it all for your clients, you're not going to sell much because it's going to be ungodly expensive. 2, nursing home is not where most people go. Most people get care at home, which is typically less expensive. So usually just want to, maybe 60, 70% of the coverage, maybe even less, depending. But so let's just say I decide I want to have a $7,000 monthly benefit. I'm in the Northeast. That means when I go on claim, Mutual of Omaha is going to give you up to $7,000. Ours is what's called a reimbursement plan. So if you have expenses up to $7,000, you could turn those receipts in, or the provider can turn them in, and we will reimburse. If you only have $5,000 worth of expenses, then we'll give you $5,000 that month. All right. So called reimbursement. So you kind of predetermine what you want. And those at KAFL could help you kind of craft an illustration to help you through that if you have no idea where to start. So next is, if I'm going to get, let's say, that $7,000 a year, how long do I want that to last? How long do I want Mutual of Omaha to keep paying that expense? So typically it can be like 2, 3, 4, 5, 6 years, something like that. All right. So you just, it's making an educated guess, and then maybe potentially what you feel your client can afford. All right. That's the other key thing to this. So let's just say I have $7,000 a month premium. Excuse me, I'm going to do a calculation here. And I want that to last 3 years. That means I have a pool of money of $252,000 to start with. All right. So I got $7,000 a month for 36 months. But now, back to my earlier comment, if I'm only using part of it, like say $5,000 a month, not the full 7, my benefit's going to last longer than 3 years. So it's not when the pool, it's not when the years end, it's when the pool money's up. So my 3 years typically can last longer than 3 years. All right. So we got monthly benefit. I want that pool of money to last 3 years, 4 years, 2, whatever it is. It just depends on your client. If I have somebody that's blue collar, I'm going to maybe only go 2, potentially 3 years. Upper middle class, 3 or 4 years. Affluent, maybe 4, potentially 5. All right. Next is if I buy this today, ideally, your client, your sweet spot is age 50 to 64-ish. And you want to buy it in your 50s if you can, while you're young, while you're healthy, and it's less expensive. All right. So if I know, let's say I'm 55 years old, average person that buys is around 56, 57 and dropping. I'm 55 years old and I have 7,000 a month. Now, the key here is the average claimant is around age 80, 81. So theoretically, I'm not going to use that for 25 years. But I still want to buy it now when it's less expensive. I'm unhealthy and I can get it. So if I have 7,000 today, but I don't go on claim for 25 years, my 7,000 is woefully not enough, right? So we add what's called inflation protection here. This can grow every year. So typically we add 3% inflation, compound inflation. So after 25 years, it's just about going to double. I'm going to have around $14,000. Now, if I have somebody's blue collar, I may only use like 2% inflation. All right. And then the next thing is your elimination period. How soon do you want Mutual of Omaha to start paying your bills? It's kind of like a deductible on a car. So my elimination period here, built in, is 90 days. All right. Now we do have riders I'll talk about that I can shorten that if I want. But standard industry is 90 days. And that's not a big deal. All right. Most people aren't worried about the first 90 days. They're worried about the next 3, 4, 5 years. So hopefully that helps ground you on just the basics here. Now I'll get into some other parts of this. You have a cash benefit. We have this in both products where I go on claim. In the beginning, claim is intermittent. And every other day or a couple hours a day. With reimbursement, typically you have to use an agency. We're saying you could pay somebody cash in the beginning, capped at $2,000 to start. It's 25% of your monthly benefit, $2,000 to start, and you can pay even your spouse, your adult children, neighbors, anybody cash in the beginning. All right, just nationally, care on average is around $56,000 for nursing home and home care. Again, Northeast, much more expensive. Private room, 104. I bet it's 150,000 in New York, Connecticut, New Jersey area. We have a calculator. You can go on our sales professional access and access this, and you could put in there your state, 3% inflation, and then put out 25 years, and it'll tell you that cost in 25 years from now. So it's great if you want to show somebody that's what the cost is today, but what it is when you go on claim. All right, so with our product, with Secure, you have an option of just a 2, 3, or a 4-year benefit. That's it. With Custom, I have a 500,000 pool of money. I could make this, depending on my monthly benefit, a 2, 3, 4, 5, 6 years potentially. And then we just upped this. The maximum monthly benefit I can get now is 15,000. It used to be 10. We just changed this June 3rd. 15,000 is the max I can get month to start, and I can add that inflation. Over here on Custom, I can make my elimination period 0 days or 30 days only or 60. I can shorten it. Now it's a rider, so I have to pay for that. I personally don't think it's worth it. I think it's too expensive. I say stick with the 90 days unless the client wants that for some reason. You have right here, waiver of premium built in. I go on claim, I don't pay my premiums. Now, one rider I add every time, if it's a couple, Right here, joint waiver of premium, very inexpensive. Very inexpensive. $150 a year for a couple. So I add that every time. I go on claim, my wife doesn't pay. Vice versa. Don't have to pay our premiums. All right, inflation. I talked about this. On secure, I only have three options, 3, 4, or 5. On custom, I can make it 1%. I can make it 1.25 right here. I can go 2.25 increments, make it 1.5. The big deal here is I have 2%, which I don't on secure. If I have a blue collar type person or teachers with pensions, things like that, I'm going to make it only 2% inflation. My upper middle class and affluent, I'm going to use 3%. But here's another big one, and we're the only ones that have this in the traditional space. I usually pay the inflation for the rest of my life or until I go on claim. But we say you can do this and stop it after 20 years or stop it after 15 years. So if I'm age 60, remember the average claimant is age 80. If I'm 60 years old, I'm going to have, quote somebody, 20-year inflation. So it stops after 20 years. It's going to save a couple like $1,500 a year. And that's going to still be great coverage. If somebody's 65 or older, I might go to 15-year inflation. Again, it saves a lot of money. This is a huge deal that others don't have. Now, here's something we have built in our policy at custom, which is one of the main reasons I select custom, is I can, on my policy anniversary, increase or decrease my inflation. Nobody else lets you do that. Nobody else lets you go up. I can go up for the first 20 years or until I hit age 65, whichever comes first. So here's an example. I'm talking to a 55-year-old. The objection is going to be, hey, John, I got kids in college. It's kicking my butt. All right, here's what we're going to do, Mr. and Mrs. Jones. We're going to start you at 1%. I have to have something on here for this to work. You said in 3 years, first kid's out of college, a little bit extra money. Man, we up it to 2%. You can afford maybe a little bit more. 6 years out, they're all done. You got more money. Maybe we go up to 4% just for a few years, play catch up. All right, you got the money here now. Age 80, I'm overinsured. I can reduce it. All right, so on policy anniversary, I can go up or down on my inflation. That's a huge deal. It gives people a peace of mind. I have this flexibility, whether they use it or not. It's a great selling tool that you should talk about. All right, some additional benefits. Big deal here. The only time I don't use this is with blue collar people. Upper middle class affluent, shared plan. My wife and I are both buying a policy. We as males think we're invincible, right? It's not going to happen to us. Well, guess what, Mr. Jones? Get over yourself. Men get ALS, MS, Parkinson's, and dementia, all with a long tail on them. So you have two policies, but if you're worried about not using it, I'm going to do this every time with a couple, except for blue collar. I'm going to connect them with a rider and makes it called a shared plan. So now we have 8 years. If I have, or let's say I have 3 years, my wife has 3 years, we have 6 years together, we can share it. So let's say me over here, I don't use it at all, pass away. My wife goes through all of hers. She can come over and use my 3 years. Or if I used 1 year, passed away, she could pick up the remaining 2. So now you're potentially offering more coverage for your spouse. All right, so that's a huge deal. Next big thing here is return of premium. Talk about that. So return of premium, a lot of people say, hey, traditional long-term care, if I don't use it, I lose it. Well, that's how most insurance is, right? I mean, people sell a lot of term insurance and use it or lose it, right? So people get that concept. Not a big deal. But every once in a while, you may get that person, 1 in 10 or 1 in 20, it goes, hey, this is a problem. Age 64 and below, I can add return of premium on here. It's reasonable. All right, so we have it age 64. I have to be age 64 or younger to buy it. It covers me for the rest of my life. All right. Next, partnership. Now, New York doesn't have partnership. Connecticut does not, but New Jersey does. I believe Pennsylvania does. PA in here. Right here is Pennsylvania. They have separate rules. This is a big deal if you're talking to blue collar people, some upper middle class. What it means, if I buy a policy and I have that 252,000 pool of money we just talked about, and I go through all of it, and now I have to start using my own money, and I have a $500,000 net worth, and I bring my assets, I start spending my own money, and I bring it down to 252,000 left, I can stop, protect that 250,000, and go on Medicaid. All right. So the government, it's a partnership between the state and federal government. They're betting you'll pass away before the policy's up. All right. Now, doesn't cost anything to add this rider. It's automatically built in. Where's New Jersey? Right here in PA. If I right here in New Jersey, if I have anywhere from 3 to 5% inflation built in to this, I automatically get it. If I have 2% inflation, I don't get partnership then. So it's up to you whether you want that or not. PA, 1 to 5%. All right. But you cannot use the 20-year or 15-year inflation with partnership. And it's kind of a big deal. I grew up in a blue collar family and on the south side of Chicago. My mother had MS for like 40 years in a wheelchair the last 20 of it. My dad had to be the caregiver. And when he realized we passed away, we had to use the home equity to pay for her care, and he could not, or they could not leave that to me and my 4 sisters as a legacy. His father was devastated. So it's a big deal and be able to protect assets for a blue collar person. Built into this is care coordinator services. I call it concierge service. Build this up. Let your clients know you go on claim. Mutual of Omaha's care coordinators that'll walk you through your family through the whole process. Give you 3 reputable in-home companies, assisted living or nursing home, and help through this entire process. That's free, built in. All right. If both couples buy a policy with us, and with most carriers, you get a discount. So us, it's 15%. If only one is applying or only one is approved, it's a 5% discount. Preferred health is 15%. Do not quote it. Let it be a surprise. All right. Do not quote it. Association, don't worry about that. If you buy it on yourself, 5% discount, and your spouse. Common employer, if you have 5 or more employees that buy it, at least 5 that buy it at once or more, they can get a 5% discount, and so can their spouse. Same-sex couples that live together 3 years, sharing expenses, get the partner discount. One thing I talk about, make sure you do field underwriting. It's one of the first things I would do if I start talking to a client or prospect, start asking questions about their health. And we approve like 80% of the applications, or only like 20% are declined. I should reword that. Like 10% are postponed. Maybe you have to wait till therapy's over or something. It's not impossible to get this, but do your field underwriting. One of the last main things here is tax favorability. Business owners can write this off. This is a huge deal. So if I'm a C Corp, I can write off 100% of this, 100%. And for my spouse. If I'm a pass-through, so I'm an LLC that's not a C Corp, I'm an S Corp, partnership, sole proprietor, I'm selling widgets on eBay. I'm gonna write this off. So let's look at age 51 to 60. I can write off $760 of my premium. And so can my wife. If I'm 61 and over in the sweet spot here, this is the sweet spot, but even 61-year-old business owner, 65, $4,710. So sales idea for you is, hey, Mrs. Business Owner, are you aware of the tax favorability of long-term care? We go, no, we need to schedule a meeting and discuss this. All right, underwriting, I talked about, do the underwriting field. So here's the last slide. I know we always like to keep these short. So look at your clients age 50 to 65 or an average or better health. That's your sweet spot. Then I would go right, business owners in that sweet spot. Next, I would look at, in your book of business, single females in their 60s and 70s. We go to age 79. I'm sorry, in the state of New York, we go to 75. Everywhere else, age 79. Single females, 60s and 70s. I guarantee you they're worried about this. They don't know they can get it. And do your field underwriting. And wealthy clients, they understand the concept of leveraging other people's money and transferring the risk. Now, some will summarily shut you down. Many of them get this. So here's the thing. Be proactive, not reactive. I get every once in a while where an agent goes to KAFL or whoever their agency is and say, hey, my client just bought long-term care for somebody else. I want to sell it to them. No, it's too late. Somebody else got to them before you did. We protect the first application in, but don't procrastinate. Be proactive. Go to your clients and bring this up. And we do pay commissions on top of this. All right. I know you do this for benevolent reasons, but we do pay commissions. So with that, I'll stop and see, Amanda and Jennifer, any final comments or thoughts?
John, this was awesome. I really appreciate, especially the sales strategy ideas. I think that's a part that we forget about sometimes. You know, we want to know who to bring this to, who are the best people to mine our books of business. I really appreciate this, especially this final slide here. I mean, you've been mentioning it throughout the entire presentation, but that's very, very helpful to us and to our agents as well. So thank you for that.
Thank you so much.
Thank you, everybody. Good luck. Have a great rest of your day.
Thank you. You too. Take
Thank
care.
you, you too.